everybody. Welcome to today's Fundamentals. Hello, Peter.
Hello.
So, what happened in the FX market in the last 24 hours?
Well, we had definitely the Fed's interest rate decision, which was the main market mover. It was characteristic that USD positions lost ground across the board. And the Fed hiked as was expected by 25 basis points the interest rates. That was not so much the interest rate mover, but I would be noting here that the bank also sounded quite dovish in the sense that it may be nearing the pausing of interest rate hikes. That was a substantial difference with the prior interest rate decision, where the bank was quite hawkish. It was characteristic that the new dot plot showed that Fed policymakers maintained the terminal interest rate at around 5.25%. That would mean practically one more rate hike by the Fed probably in its next meeting, and then it's going to be pausing. So overall, despite the bank actually hiking rates, it was a dovish hike, which tended to weaken the USD and more or less end the uncertainty to some degree regarding the bank's intentions about the future.
And how have the US stock markets reacted?
Interestingly enough, we had a drop of US stock markets practically on the prospect of further monetary policy tightening. And that would imply practically that the conditions in the US economy are still to tighten even further, given that we have a lagging effect of interest rate decisions on a cumulative level, which may kick in the coming months. So things are still about to get worse, and I would note that we may see some slowdown in the growth rates of the US economy.
And what about gold prices?
Gold jumped. It was characteristic how the precious metals price maintained its negative correlation with the US dollar. The US dollar dropped. At the same time, we had a rise of gold's price. I would expect that most probably, should the USD continue to weaken, we may see some additional gains for the shiny metal.
And so what's in the calendar for today?
Well, we already had SMB's interest rate decision. The Swiss National Bank practically hiked rates by 50 basis points. That was also the market consensus. It was characteristic how the Swiss franc gained from the decision, as it strengthened against the US dollar by around 26 pips at the moment of the release as such. And other than that, I would also note that we had a rate hike also by Norges Bank by 25 basis points. That was more or less expected as well. I would highlight the release of CBT's interest rate decision from Turkey. The bank is expected to keep the 1 week repo unchanged at 8.5%. However, there is a slight chance that we may see the bank opting for a rate cut, in which case we may see the lira weakening further. Mind you, that the Turkish lira, especially against the euro, has weakened during today's European session and has reached, Euro TRY has reached record high levels. It was very, very characteristic. There's a long upward trend line guiding the pair since around the last days of 2021. So we're talking over almost 15 months. And I think that's very, very characteristic of how weakening the TRY is. That's one. The second, and I think that's going to be the highlight of the day, is Bank of England's interest rate decision. Now, up until last Friday, the expectations were split for the bank, whether it will be remaining on hold or whether it's going to be proceeding with a 25 basis points rate hike. That question mark seems to be ending after yesterday's release of the CPI rates of the UK, which accelerated beyond expectations, both on a headline as well as on a core level, and both on a month-on-month as well as on a year-on-year level. So practically we see inflationary pressures not just simmering under the surface, but being strong, highlighting the cost of living crisis in the UK, and practically forcing BOE's arm to actually proceed with another rate hike. It's characteristic that GBP OIS over the past 24 hours have been above 90%, that the bank is going to be hiking rates by 25 basis points. The big question here now is, should the bank actually proceed with a 25 basis points rate hike as expected? What's going to be happening with the forward guidance? In the last interest rate decision, the bank had signaled that it's nearing its terminal rate and was about to pause rate hikes. Should that be reiterated today as well, that may practically turn the hike into a dovish hike and weaken the pound. On the flip side, should the bank actually maintain a confident hawkish tone given the acceleration of the CPI rates yesterday, that may provide additional support for the pound and send the sterling flying.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yazid.
So welcome to the technical analysis part of the presentation for the day. My name is Peter Yusuf, Senior Market Analyst at IronFX. We note that in front of your screens you have the US dollar index. It's the 4 chart. All charts to be presented are to be of the same time frame unless otherwise stated. With no time to waste, let's make a start with the USD index as noted. We note that the drop of the US dollar accelerated yesterday, with the main event, the main factor behind the weakening of the US dollar being definitely the Fed's interest rate decision. I would like to drill into the 1-minute chart. Let's see the market reaction in the US dollar index at the time of the release of the Fed's interest rate decision, and more or less note the wide drop here. It was so we had a drop of around 48 pips upon the release, the minute of the release. Yet we have to note that, let me show it a little bit more graphically. In the red ellipse, we had the wide drop, but you can see that the overall movement was even wider, and that tended to exactly show that practically at Fed Chairman's press conference later on, intensified the bearish movements. Note the wide drop here, which practically culminated in, let's have a look how deep it was. And it was at around 100. It was a very wide drop. Okay, Let's delete this. Clear. Readjusting the chart back to the 4. Definitely the first move would be to switch the role of the 102.45 from a resistance line, from a support line to a resistance line. So let's color this in red, lock it in. Let's go hunting for a new ultimate support line, the S3. This is a nice show here. It was a nice intense downward movement which was stopped. We could also pick this one, but I would prefer that one. And in green, that would be the 93.85 support line. Locking everything in. Let's correct also the labels before we discuss direction. Repositioning the labels for now. Starting with the R3, which is now being placed at 103.75. The R2 at 103.05. The R1 at 102.45. The S1 at 101.35. The S2 at 100.65. And the S3 at 94.85. There we go. Definitely the downward trend line remains quite intact. On the contrary, we may see that there was an intensification of the US dollar index's drop, signaling exactly the weakening of the US dollar. It was characteristic that also the RSI indicator dropped below the reading of 30, which more or less highlighted exactly the bearish tendencies, but also showed that the index had dropped to oversold levels and was ripe for correction higher, correction which is being performed right now in today's European session. Yet as long as the downward trend line remains intact, we tend to maintain our bearish outlook. For the time being, we treat the correction higher as merely a correction, just that. It's in our opinion not a change of trend just yet. So should the downward trend line remain intact, we would expect the price action. It could correct a little bit higher even, but we would expect it to turn downwards once again, possibly breaking the S100 and 135, a level which could be lifted a little bit, as we have a neutral here. For the time being though, because we have multiple touches, 1, 2, 3, at this level, I'm keeping it. It's pretty wide, the distance between the R1 and the S1, but I would expect the price action to reverse, break below the S100 and 135, and start aiming for the 165. That's under the condition that the bears still have a strong hand over the index's price action. Should there be a stabilization, and that would be more evident in the next 24 hours, we may see the index breaking the downward trend line of the US dollar index and practically remained in the spectrum of the 102.45 and the 101.35. Such a sideways motion would allow us to readjust the S1 once again, possibly a little bit higher as mentioned before, near this true here. For a bullish outlook, despite that scenario being remote, it's still possible and we should cover it. In which case we may see the US dollar index rising, breaking the downward trend line, once again a signal of a changing trend, but also break the 102.45 resistance line and start aiming for the 103.05. So there's still some volatility left. The question is to which direction. For the time being, and as long as the price action remains below the downward trend line, we tend to maintain a bearish outlook. Also note that the 100 in orange, the 50 in green, and in blue the Bollinger Band median, the 20 moving average, all three of them are pointing downwards, which tends to highlight exactly the bearish tendencies of the US dollar. Moving to Euro USD, which had the opposite movement, and you see a very proud analyst here, as practically the R1 1.0925 held its ground. So the level which was set by the peaks here and here was valid once again during today's European session. It was able to successfully reverse the upward motion of the pair. It's not a clear reversal. It seems to be, for the time being, a correction lower from the market's overreaction in the past 24 hours, not even 12 hours. And I would be noting that I think that would be also interesting to see how the RSI's upward movement seems about to be interrupted. Here it is. It's being tested right now. The RSI indicator, which broke above the reading of 70, once again highlighting the dominance of the bulls, but on the flip side also warning that the pair may have reached overbought levels and may be ripe for correction lower, something which is happening right now and during today's European session. For the time being, once again, and as long as the upward trend line remains intact, we tend to maintain our bullish outlook for the pair. In which case, should the bulls actually maintain control over Euro USD, we may see the pair correcting a little bit lower, but ultimately it should bounce on the upward trend line or even shift it a little bit to the right and then start moving upwards once again, probably breaking above the 1.0925. Don't forget that for an upward trend line to be maintained or the upward movement to be maintained or to be clear, I would require a higher peak than this one. Now, should the pair stabilize, I would expect it. Definitely the first signal would be a breaking of the upward trend line, but I would expect it to respect the R1 1.0925 as it did here, and at the same time also the 1.0760 as it did here. So that would bring us to a movement like this. Should the bears take over, we may see the price action of Euro USD dropping. Once again, we highlight the necessity of the price action breaking the upward trend line and signaling a change of trend. But in the case of a bearish outlook, we would require also breaking of the S1 1.0760 before the pair is actually able to start aiming for the 1.0525. I don't expect it to drop this low, but I would require clear break of the S1. Clear breaking of the S1 would allow us to more or less start drawing or drafting at least a downward trend line showing us the limitations of the downward movement. And to that end, we would require a lower peak, lower trough than the S1 once again. Moving to GBP USD. So despite a correction lower after breaking the 1.2265 resistance line, the bulls had it and were able to push it once again above the 1.2265. For the time being, we tend to maintain our bullish outlook as long as the upward trend line remains intact. May I remind you that we had three, give me a sec, consecutive higher peaks. pair, and the third one here. So you see that we have 1, 2, 3 peaks, higher peaks in a row, but I would also be noting the consecutive higher throws in blue color. And another one. Yeah. I would be highlighting also another factor, which is also of interest. We can see that the distance of the height of the peaks tends to become lower. So practically, yes, they're still peaking at higher points, but the distance from peak to peak becomes lower. And that may be implying that the pair is finding more and more resistance as it pushes higher. It should be considered that the pair's RSI indicator hit the reading of 17 corrected lower. It's currently at 59.3, which shows a rather considerable drop. Okay, it's not the magnifying drop which is about to turn a bullish sentiment into a bearish one, but it seems as if the bulls are slowly losing their grip. Nevertheless, for the time being, and as long as the upward trend line remains intact, we tend to maintain our bullish outlook. So for the time being, we expect that the price action is going to be bouncing on the upward trend line and start aiming for the 1.2435, a level which provided considerable resistance as it was in the upper boundary of the pair's past sideways movement. You can see this in the rectangle, which is colored in yellow. On the other hand, should the pair actually start stabilizing, I would expect it to break the upward trend line once again in a first sign of a changing trend, yet at the same time remain just above or around the 1.2265 support line. For a bearish outlook, I would require the pair to drop, break the upward trend line, clearly break the 1.2265, and I wouldn't be satisfied up until the price action has reached the 1.2105. Definitely we need a lower throw than this one in order to start considering even a bearish outlook. Anything which remains in this spectrum, i.e. from this throw to this peak, a movement like this, would be a sideways motion in our opinion. Yet should the pair drop, break the upward trend line, break the 1.2265 and reach, if not even breach, the 1.2105, that would be a nice clear signal for the possibility of a bearish trend beginning. That may allow us even to start drawing a downward trend line showing exactly the limitations of the downward movement for cable. Once again though, for the time being, and as long as the upward trend line remains intact, we maintain our bullish outlook. Let's have a look at Safe Haven USDJPY. Okay. JPY was actually one of the main gainers of yesterday's USD weakening. And it's characteristic that despite rising slightly above the 1.3255 and reversing it into support line, it quickly dived just below it. So for the time being, we're going to have to switch the role of the S1 into resistance line. And we need to go hunting for a new ultimate support line. It's nice how the pair bounced on the 130.40, the S2, which exactly showed the validity of the support line once again. Let's unlock the chart, go back and find a new ultimate show for the S3. This is an interesting level. Okay, we have this show, but in my opinion, that's too close to the S2, so I'm leaving that. This is an interesting level. Why? Because on the one hand, it has a nice touch here to the upside and a nice touch here to the downside. We could discuss even a lower level like this, where you have another touch and another touch. Actually, I think this is a more clear resistance line. Note how deep the upward movement was, which the level here stopped and forced the pair to drop once again below it, correcting lower and then regaining its upward momentum. On the other hand, though, note that there was some slight bearish tendencies, but they were stopped by the same level practically on the mid of April. In green, and let's have a look at 125. Could be 125, 125.05. I think it's good. 125. Here could be a little bit higher, just a tiny bit, but that's good as well. Readjusting the chart, let's reposition the labels and correct them. Starting with the 137.80. Yeah, 2 is now being placed at 135. The R1 at 132.55. The S1 now placed at 130.40. The S2 128. And the S3 at 125. Locking in everything. Now let's discuss direction. And we have a number of elements here. Definitely the fact that the price action was not able to clearly break above the 132.8055 tends to highlight that there was an upper limit here. On the other hand, though, we have to also note that over the past 48 hours, the price action broke the downward trend line guiding the pair, and at the same time also bounced, as we have mentioned before beautifully, on the 130.40 support line. So there is the idea here that we may be seeing a confinement of the price action between the R1 132.55 and the S1 130.40. So I would expect a movement like this. And give me a sec. Yeah. On the other hand, though, I would be noting that Give me a sec again. Yeah, we definitely don't need this. Now, for sideways motion, which for the time being remains our base scenario, we would expect the price action to to move between the 130.255, which provides the resistance here, and the 130.40, which provides support here. There is also, though, the possibility that the bears may regain control over the pair should the US dollar start weakening once again, which is quite a possibility. Then we may be seeing a new downward trend line starting to form. And in that case, though, we would expect the price action to drop, clearly break the 130.40 support line, and start aiming for the 128 support level. On the other hand, should the bulls take over, we may see the price action rising, breaking the 130.255 resistance line, and start aiming for the 135 resistance level. I know it's a far-fetched, but definitely I would require a higher peak than this one before calling in the bulls. Note the RSI indicator. That tends to imply that the bearish sentiment seems to be easing. It's characteristic that it almost reached the reading of 30. It was at 33 and corrected a little bit higher. It's right now at 39. But the bears are still there. I wouldn't be neglecting that so easily. And that's highlighted more by the downward slope of the moving averages. And we note that the 100, the 50, and the Bollinger Median, the 20 moving average, are all three pointing downwards. So the bears have not exactly left just yet, at least. Okay, let's have a look at USD CHF. Nice downward motion. It's interesting how the pair even broke the 0.9160 during today's European session, yet almost reached back up, almost forming a dodgy candlestick. Definitely SMB's interest rate decision was involved here. Let's have a look. Let's drill to the 1 minute chart. Unlocking it, widening it. Here it is. A beautiful, beautiful, strong downward motion. Here you go. And that would encompass practically, if I'm correct, around 37 pips and a half. Yeah. Let's change the color into red. But there was a strengthening of the CHF against the US dollar during today's European session due to exactly their interest rate decision, the decision to hike rates by 50 basis points. Back to the forward chart, readjusting. Now, is the downward motion about to continue? I think before we discuss that, we should start considering whether to change the S1, and I would actually do that. And let's go hunting for a new ultimate support line. Always in the forward chart, moving further and further back. Okay, here we are. we have a double hit at this level. We can note it here and here. And it encompasses, note how it encompasses the sideways motion of the pair. Allow me. This sideways motion, with this level being the low boundary, and that was practically from mid-May 2021 up until mid-June 2021. So that was a month's movement here, which was quite sideways. And definitely this level was the low boundary. You can see the double hit, one, twice, testing here, false break. I'm keeping it. It's a little bit off, it's a little bit wide, but in my opinion it's still valid. And that would be the 0.8930. Okay, let's readjust the chart and make the necessary corrections. Repositioning the labels. Let's correct the labels as well. Starting with the R3, which is now being placed at 0.9335, the R2 at 0.9240, the R1 at 0.9160, the S1 at 0.9070, and the S2 at 0.9015, with the S3 newly acquired being set at 0.8935. Let me recheck the last level. Nope, it's at 0.8930. My bad, sorry. Okay. So everything's in place. Let's discuss direction. There's still a clear downward motion of the pair. I would be noting also the RSI indicator, which is at the reading of 30, more or less exactly highlighting that the bearish sentiment is still strong for the pair and could push it lower, in which case we may see the pair start aiming for 0.9070. On the other hand, should the pair stabilize, we may see it revolving around the 0.9160. While a bullish outlook, we would require a clear rise, a break of the 0.9160, and the pair to reach, if not breach, the 0.9240. That would be practically breaking also the downward trend line which we had up until yesterday. Let's move to commodity currency AUD USD. There's a clear formation now. It's a very subtle, but I think it's quite clear. Let's clear the board. let's delete everything. Okay. Now we see that AUD/USD has started to form consecutive higher truths and higher peaks. And that allows us to draw an upward trend line like this. It's a very subtle one, but it's still there. Numbers don't lie. And one could even discuss this upward trend line. But I think it's not that intense. It's interesting also the fact that the pair has broken above the R1 0.6695 and it's a clear break. Let's turn this into support line. Let's go hunting for a new ultimate resistance level, and I would place it on this peak here in red. 0.7155, widening the chart a little bit. Let's correct the labels, reposition them first. Starting with the 0.6460. Oh, my bad, sorry. Second support line being placed at 0.6585. First support line being placed at 0.6695. First resistance line being placed at 0.6855. Second resistance line at 0.7010. And there are three being placed at 0.7155. Looking everything in. So overall, we tend to maintain our bullish outlook for the time being. And in that case, we may see the pair, given that it has broken above the 0.6695 rather clearly, start aiming for the 0.6855. On the other hand, should there be stabilization, I wouldn't be surprised to see the price action dropping, possibly breaking slightly the S1, even the upward trend line, and continue to revolve around the first support line. On the other hand, for bearish outlook, we would require a clear breaking of the S1, a clear breaking of the upward trend line, yet I would also require the pair to aim, if not breach, the 0.6585, the S2, the second support line, a support line which provided support here consecutively and here as well. Let's have a look at USD CAD. Nice, interesting downward movement, but it verifies actually two things. A, the validity of the S1, 1.3665. Note how it was tested a number of times here. B, the sideways motion. There's a sideways motion of USD CAD which cannot be neglected. Also, the RSI indicator is just below the reading of 50. It's actually at 48.4. So that tends to imply also rather indecisive market, or at least that the bears have relinquished the control over the pair. I would expect the price action to remain in the sideways motion, just above the 1.3665 for the time being. Should, though, the pair actually move decisively lower by breaking this 1.3665 and start aiming for the 1.3520, that may allow us to switch our sideways movement bias in favor of a bearish outlook, and that would allow us also to draw a nice clear downward trend line, showing us also the possible limitations of the downward movement. For a bullish outlook, I would require the pair to rise and break above the 1.3805 decisively. I would require not just a peak higher than just this one. No, that's not enough in my opinion. It has to be a peak higher than this one in order to be able exactly to form an upward trend line which may guide the pair and may allow us also to show any limitations or to identify any limitations of the upward movement. Note how the Bollinger Bands have narrowed here, which could imply that volatility is rather low and may exactly allow the sideways motion just above the 1.3665 to be maintained. It's very, very indicative, and it's very, very indicative how the moving averages, especially the 100 and the 50, the 100 averages in orange, the 50s in green, have flattened out, also implying a sideways motion. Okay, that should be it from all of us here at IronFX. Best wishes for solid trading.
Hello and welcome to another educational video. As part of our technical analysis series, we would like to look at trend lines. A trend line helps technical analysts determine where market prices are heading. A trader using technical analysis will utilize trend lines to identify and confirm market price trends. This is based on the idea that price trends. The trend line is nothing more than a straight line drawn between at least 2 or more points. An uptrend line has a positive slope and it's formed by connecting 2 or more low points. In order to have a positive slope, the second low must be higher than the first. Uptrend lines act as support and point out the net demand is increasing as the price rises. An increasing price combined with increasing demand is very bullish and shows that buyers are determined to buy. If prices remain above the trend line, the uptrend is considered solid. A break below the uptrend line suggests that net demand has diminished and a change in trend could be looming. A downtrend line has a negative slope and is created by connecting 2 or more high points. The second high must be lower than the first for the line to have negative slope. To confirm that the trend line is valid, at least 3 points must be connected. Downtrend lines act as resistance and demonstrate the net supply is increasing as the price drops. A falling price combined with increasing supply is very bearish and shows that sellers are determined to sell. If prices remain below the downtrend line, the downtrend is considered solid. A break above the downtrend line indicates that net supply is falling and that a change of trend could be looming. The trend line becomes more important and more credible as the number of price extremes that can be connected by a single line increases. The validity of a line that connects only to price extreme is questionable. Most often traders can take profits too early. It is best to stay with the trend until it breaks, avoiding the desire to sell too soon because the profit could be higher than originally anticipated. Thank you for watching.
Okay, hi everyone. Welcome to today's webinar. So today we'll be doing Fibonacci series, our first part of 4 on retracements. So we'll give a couple more minutes to let more people join our meeting. I will start perhaps at 6:05. So in the meantime, you can grab a drink, get yourselves comfortable, and then we'll start in a couple of minutes. Maybe in the meantime, I'll do like a sound check. Can everyone hear me? And can you see my screen? Yeah, okay, that's great. Chat is disabled. Okay, let me try and sort that out. Thanks for letting me know. Okay. Okay, maybe you can try the chat again. I've just tried to refresh the chat. It says everyone can type in the chat. Okay, let me try and figure that out. But this Q&A works. I can see all of your questions, so that's great. Okay, let me try and figure it out. Okay, can you try now and let me know if it works? Okay, that's great. Okay, there was something with the settings. But yes, I've managed to figure out. Yay. Okay, how's everyone doing today? Yes, Sven, it works now. No problem. Okay. So, where are you guys from? Today is actually my first webinar in a couple of months. So it's good to be back. No, today I'll is the first session for the Fibonacci series. So just be on retracements. Things like the expansions, extensions, and projections will be in the coming weeks. So today we're just solely focusing on retracements. Wow, Finland and Germany. I bet it's really cold there now. Singapore is hot all year round, so I can't relate. Okay, I'm just checking to see if everyone is here. See if I should wait a little bit longer. Yeah, because people are still joining the call, so just be patient with me. Okay, Sven says it's -3 degrees right now in Germany, and in Singapore it is, I think, 27. So -3 must be so nice. I'm sure the weather is like so nice and relaxing. Whereas in Singapore we're constantly sweating. It's uncomfortable. Oh, remember, you guys can just let me know in the chat throughout the webinar if you have any questions. Oh, we have someone from Mozambique and another from Africa. That's so cool. I forgot how international these webinars are, so it's so nice to speak to people from all different parts of the world. Okay, I think we can begin. Okay, yeah, let's begin. So, hi guys, I'm Melanie. Today is my first webinar, so be patient with me as I get back into the swing of things. But today we'll be going through the first part of our Fibonacci series. It'll be on retracements. So if you have any questions on projections or expansions, we'll be touching a little bit on that throughout the webinar, but we'll go more in depth in the coming weeks. So as usual, our disclaimer, the information in this webinar should not be considered as investment advice or recommendations, and it's solely educational material only. So take any piece of information from this webinar at your own risk. And IronFX is not responsible for any loss arising from any information contained herein. Okay, so this is me. I'm Melanie. Yeah. Okay, let's just begin. Okay, so here's our agenda for today. Firstly, we'll be going through the essentials of Fibonacci retracement, followed by the ideal market structure. So what you can look out for, significant swings, how important it is to follow market trends. And then we'll be going through the different Fibonacci levels. So we'll also be touching a little bit on expansions as well as Fibonacci extensions. We'll also be talking about the difference between those as well and how to look out for them when you're trading. So after that, we'll be going through how to combine the Fibonacci retracement levels so that you can increase your chances of a profitable trade. And then we will introduce something called the Fibonacci confluence area as well. And then, this is a typo. After that, we'll be going more in depth, talking about the negative Fibonacci levels as well as the levels more than 100%. Okay, so let's begin. So here's a simple checklist to follow when first starting out with Fibonacci retracements and some things to look out for. So firstly, is the market structure clear? So we like to look for really big zigzags. I'll show you what we mean in the coming slides. Secondly, we want to identify recent trends. So is the price going up or down? It's important to always follow the general trend. So you can see in the image that I have included over here at the bottom, our starting point is at the top and our ending point is at the bottom. So we can see that there's a very clear downward trend. Okay. Thirdly, you need to identify recent major swing lows and recent major swing highs. So we'll also show you some examples of this in the coming slides. So it's also important to connect the two extreme points, so from highest to lowest or lowest to highest, depending on the general trend. So we'll show you why this is important in the next few slides as well. So over here, we have an example of insignificant swings. So you can see the charts are rather choppy. There isn't really a very clear price movement. And this is what you want to avoid. So this is an example of something that you should not use Fibonacci retracements for. Okay, and this is something that you should look out for, significant swings. So something that has very obvious peaks and peaks and troughs. Yeah, over here. And a very clear move up or down. You also want to make sure that you look for a very clear market structure. So Fibonacci retracements should not cut through too large areas of the market structure. You definitely can, but it shouldn't deviate too much from the price movement. So in this case, we can see there is a zigzag structure, and the retracement drawn here cuts through the market structure, which makes it less effective. So when drawing your trend line, you want to make sure that it doesn't deviate too much. Because you can see from here, our starting point is here and our ending point is here, which cuts through a very large area of the price movement. Okay, let me just check. I'm just checking the chats to see if we have any questions. Okay, someone asked what time frame should be used. I'll get into that in a second, but mostly we want to use the larger time frames so that there's less noise when you're trading. Okay, so this is an example of something that you want to do. So you want to pick market structures with really clear upward or downward movements. As you can see over here, the starting point is at 0.1, ending point at 0.2. So you can see a very clear downward general trend. Even though it does cut a little bit over here, but that's fine because it doesn't deviate too much from the price movement. Okay. So answering your question earlier, these tend to work better on higher time frames. So like H1 onwards, H1, H4, and so on and so forth, because there's less noise compared to your M5 or M15. Okay, so this is an example of a clear market structure. So although Fibonacci retracements definitely can be used for both choppy and trending markets, and what I mean by trending markets is markets that have like a really general trend, like earlier in the earlier slides. But over here, you can see there's quite a bit of movement, but the Fibonacci retracements can be used for these as well. But it's important to look for clear market structure. That's the main point. Over here, you can see this is an example of an unclear market structure. Okay. So one thing we can do to find clearer market structures for our Fibonacci analysis is to adjust the time frames so that the market structure is clearer. So what might look messy on an M30 chart might look very clear on an H4 chart. So I'll show you in the next slide. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point of time. It could just mean that you need to take a step back to get a clearer view. So I'll show you what I mean in this upcoming slide over here. So this is an example of a chart on an M15 view. So you can see there isn't really a very clear trend, no clear market movement as well. But if we zoom out and we look at the 1 hour time frame, it's quite clear, especially in this highlighted area. So we have much clearer movement, and it's less messy compared to the M15 one. Okay, any questions so far? No? Okay, let's move on. Okay, so from the past few slides, this first section, it's important to note that the clearer the swing low or swing high, the clearer the trend between the 2 points, the more accurate your Fibonacci retracement will be. So that should be the main takeaway from the first few slides. Okay, so now that we know how to draw Fibonacci retracement trend lines and we know what to look out for, let's look at the different types of levels ranging from negative all the way to more than 100. So in the negatives, we have minus 61.8 and minus 27.2, which are classified under Fibonacci expansions. And all of these in the middle are your Fibonacci retracements. And then above 100 will be Fibonacci extensions. So like I said earlier, we'll go in more in depth in the coming webinars, but we'll just briefly introduce them and how to go about using them as well. Okay, so over here, it just shows you an example of all of the levels that I've mentioned earlier. So for here, the starting point is at this level. Oop. Ending point is over here. Okay, so here's an example of the Fibonacci expansion and how it plays out. So our starting point is here, ending point is here. So for expansion, you want to look for a flash zigzag, which you can see over here from the arrows. It's like a flash kind of symbol or a lightning bolt. So you want to look out for these when you identify Fibonacci expansions. So you retrace the mid-range from here to here. And you make use of the support in the negatives, which means like the negative 27.2 and the negative 61.8. So we expect price to retrace back up to this 61.8% level because price has tested this level earlier, as you can see over here. So it tested this level and then it reversed off. So we expect it to come back down to this negative 27.2 or even negative 61.8. So I'll show you in the next slide how it actually plays out. So here we see the price really reacted off of our minus 27.2%, and then it came back up to our ending point. So typically price, not always, but typically price will come back to the ending point after bouncing off a negative Fibonacci retracement. Sorry, a Fibonacci expansion level. Okay, so let's move on to Fibonacci extensions. So those beyond 100%. So when using the 127 and 161.8 levels for extensions, we want to look out for the V shape or Nike tick as shown here. So in this GIF, you can see how how price bounces off of these levels. Let me just start it all over again. Okay, here. So this is our starting point. The shorter end of the tick is your starting point and ending point. And then price will continue to rise from these levels. And after it's reached this level, it reverses off it. We can see over here that it tested the level once again, but it ultimately bounced off it to reverse and drop back down. Okay, let's move on to the next slide. Okay, so when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from the top to the bottom, if there are bars on the right that break your ending point, it becomes invalid. So there are Fibonacci retracements that are negative, so like the negative 27 and negative 61.8. And we'll touch on these as they go basically beyond the endpoint, and yet they are still valid. So I'll show you what I mean over here. So this is an example of an invalid retracement. So the ending point, which is here, you can see that price actually reversed off the ending point, but it made a lower low. So this Fibonacci retracement over here, the trend line, is now invalid. Sorry. So similarly, if it's going higher, if it breaks the ending point and it goes even higher, then it's invalid as well. Any questions so far? No questions? Okay, let's move on. Okay, repeat the last bit. Okay, so how you identify once your Fibonacci retracement is invalid is when, so you can see over here, price is moving downwards. In this case, it's a downtrend. So when it's moving down, do you use this lower low as a new ending point? Yes, correct. Yeah. So you can see it's moving downwards. This is originally our ending point. But since price reversed off this level and went even lower, so this should be our new ending point. So even though I said earlier that you shouldn't cut through the price movement too much, in this case, it's not a large area, so you can still cut through this area because the general trend is still downwards. So this should be your new ending point. I hope that's clear. Okay. Any other questions? See the previous slide. Sure. No worries. So the main key point is that once it breaks your ending point, it becomes invalid. Okay. Okay, let's move on. So now let's take a look at Fibonacci extensions. So here you can see a very obvious Nike tick. the starting point is here, ending point is here. For Nike tick, you want to take the shorter end of the tick, the starting point. So you retrace this area, this trend line is over here. And it results in a reversal over here. When you use this trend line, it gave us a 161.8 projected level. So we are expecting it to rise to this level and reverse off of it. Oop. So 127 would be perhaps in between here. So you might want to wait for price to break through the 127 level before going in for this trade at 161.8. Okay. Okay, let's move on. So we've gone through earlier the key Fibonacci levels that work, the expansions, extensions, as well as the retracements. So there's always a huge debate on whether some levels work better than others, but the truth is that Fibonacci retracement levels work sometimes, but they work all the time. So that's the problem. So how do we minimize this issue and increase our chances of being profitable? So what we've come up with that works by combining Fibonacci retracements. How do you expect that it will go to 161 and not 127? Okay, so so as I mentioned earlier, 127 would be perhaps around this area. So you might want to wait for price to break through the 127 level before going in for the trade for 161. Because at the 127 level, it could reverse or break through. So you want to wait for it to break through before going in for the trade at 161. Does that make sense? Okay. Okay, no worries, because let me just try and explain it again. Because the 127 level is obviously below the 161 and above the 100. It's in between. Should be in between this area here. So if price hasn't reached the 127 level yet, it's not advisable to go in for the trade at 161 because it hasn't broken the level yet. So it could reverse off of the level or it could go up. So in this case, we know that it went up. So after it breaks through the 127 level, then we can go in for the trade at 161 projected level. Okay, I hope that helps to clear things up. Okay, so let's talk a bit about combining the Fibonacci retracements. So the trick is to find multiple Fibonacci retracement levels that line up together so that you can increase the probability of a bunch of Fibonacci retracement levels working instead of a single Fibonacci level working. So this is the definition of Fibonacci confluence. So we'll show you an example of what we mean and how this can play out in the next few slides. So, okay, maybe I'll start with this photo first. So over here, we have a negative 27% Fibonacci retracement. So you can see this is the starting point and the ending point is here. Okay, so then we have a 161.8 Fibonacci retracement. So that would be starting point here, ending point here. And then we have a 78.6% Fibonacci this should be Fibonacci retracement, sorry. The 78.6. So that all lines up nicely, and we expect price to bounce off of this confluence area, since all three of our Fibonacci levels line up together. And you can see that price really bounced off this area, and it resulted in an uptrend after that. Okay, I have a couple more examples, so if you're a little bit confused, don't worry about it. But if you have any questions, you can pop it in the chat as well. All good. Okay. So here's our first example. So we have a Fibonacci retracement starting from here and ending here. And this gives us a 50% Fibonacci retracement. And the level is in yellow, this level over here. So that's the first one. Secondly, we have a Fibonacci retracement starting from here and ending here. And this gives us this green area over here. And then it lines up nicely with the 50% Fibonacci retracement. Okay. So lastly, we have a 127.2% Fibonacci expansion starting here and ending here. So ultimately, we have three Fibonacci retracement levels all lining up, and it gives us a very strong Fibonacci confluence area. So what we expect is that what we're going for is to play a bounce from a strong area of Fibonacci confluence support, which is basically all the colors lining up this area. Okay, so we'll show you the result of this. So as you can see in this picture, price went down to touch this strong area of Fibonacci confluence support, and it bounced up nicely. Okay, any questions so far? Yeah, so you're combining one big Fibonacci retracement level with two other smaller Fibonacci retracement levels. So you can see this is the really big one, and then you combine it with the two smaller ones over here, the green and the red. So you just pull out your Fibonacci retracement levels, and then you can just connect from the starting point to the ending point of each. And then you see where the levels line up, and that should give you a strong area of confluence. Okay, hope that clears things up. Okay, let's move on. So here we have another example. So in this example, we combine one Fibonacci retracement with two Fibonacci extensions. Okay, so the very first one, let's start with the yellow one. Starting point here, this is our middle point, and our ending point is here. So this is the Nike tick that we mentioned earlier, the Fibonacci extension. Okay. And it gives you an 88% Fibonacci extension, which lines up with the 61.8% Fibonacci retracement. Starting point here and ending point here. You can see a very clear downtrend here. The green arrow. Okay. So for the last Fibonacci extension, we have another flash over here, the red arrows. So remember, for Fibonacci extensions, we're looking for the flash symbol or lightning bolt symbol, however you want to call it. So for yellow, it's like this. For red, like this. So for red, it gives us a 61.8% Fibonacci extension. So we can see that all these three levels line up. And it gives us a strong area of Fibonacci confluence to trade from. So what I would do is wait for price to make a push up to this area, because currently price is at this red line here. So I wait for price to make a push up to this area, and when it touches this area, then I would short the market and play the drop. Okay, so this is what I mean. By waiting for it to go up to this area and wait for the reversal before you short. Any questions about this second example? Okay, so let me just go back to the previous slide. Yeah, so here you can see there's three different Fibonacci, two different Fibonacci extensions, as well as one Fibonacci retracement. So the Fibonacci retracement is the one in green. Fibonacci extension is the yellow and the red. And how you know this is because of the flash symbol. So like, it's like a lightning bolt. Yeah. Okay. I'm just reading some of the chats or the questions. Okay. Okay, I'll move on. So for the third example, we're bringing in support and resistance levels. And this leads to really high probability setups. So here is an example of how we combine pullback resistance and two Fibonacci retracements as well as a Fibonacci extension. Okay, so I'll show you where each of them are. The red level over here is the pullback resistance. Because price tested this area, it bounced off of it, and it crossed this area over here. So this is a pullback resistance. The Fibonacci retracement is the yellow line, starting point here and ending point here. This gives us 61.8% Fibonacci retracement, which lines up with Fibonacci extension, which is over here. We can see the flash sign again in the green arrows. Can you guys hear me? Someone said they can't hear me. I think the audio is fine. Okay, let me just reply. Sorry. Okay. Where was I? Okay, yes. So you can see the flash over here, the flash signal. This is a Fibonacci extension, the green arrows. And then we have another Fibonacci retracement, which is the red arrow. Okay. And all of these three levels line up with our pullback resistance. So it's a very strong Fibonacci confluence. And it's also a high probability reversal zone that has the potential to see price reverse strongly from this area. So in such situations, you could place a short entry over here at this area. Okay, let's see how this played out. So you can see price reversed off of this area. And it reversed right as it hit the confluence area. So because this area is so strong, and you can tell based off of the Fibonacci retracements lining up, as well as the pullback resistance, or any support and resistance levels that line up with the Fibonacci retracements, should give you a very high probability reversal zone. Okay. Are there any questions about any of the three examples that we've gone through so far? Yeah, I'll give you guys some time to digest what I've just gone through from the three examples. Sorry, catching a cold because it's been so rainy in Singapore. Okay, so the main point from all of the three examples is basically to stack a bunch of Fibonacci retracement levels or support and resistance levels to try and get the most high probability confluence area that you can get, and then see whether it has a high potential for price to reverse off of it. Okay, let's move on. So here's some trade management tips with the Fibonacci confluence. So for stop loss, it should always be beyond the key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you'll most likely get stopped out right before the market reverses. And this is one of the reasons most people wonder why they get stopped out right when the market starts to reverse, and then they complain about it. So, but not you, because now you know. So you can see over here, your stop loss is below it or beyond this Fibonacci confluence area. So there's some buffer over here. So just in case the market doesn't go exactly how you expect it to, when you buy. So your stop loss is, there's some leeway. Okay, so let's move on to the take profit. So your take profit should always be before your Fibonacci confluence. I see the slides are slightly incorrect, but for take profit, it should always be before a key Fibonacci confluence area. And the reason for this is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. So you can just ignore the slide here, but take a look at the image below. So our take profit is before the big confluence area. Why? Because there's a high chance that it will not be able to go beyond this area. So instead of reaching your profit target, it might reverse back to your entry, or even worse, your stop loss. So this is one of the reasons why people may complain that the market is being manipulated, because they miss their TP, their take profit, by 1 pip. So you should always put it before the major Fibonacci confluence. As you can see, there's also some leeway over here. So there should always be a little bit of buffer between the Fibonacci confluence as well as the take profit and stop loss. More of like a just in case measure. Are there any questions? Okay, I think there are no other questions. So that brings us to the end of our webinar. Okay, so before you guys go, let me just pull it up. So IronFX actually has a VIP trading room. Not sure if you guys know, but I'm just gonna let you guys know right now. So depending on your deposit, you can access the different premiums. This is on the ironfx.com website. So you can just take a look over here and you get VIP room access. And what I mean by that is over here, this brings you to our page. So let's say, for example, today we went through Fibonacci retracements. So you've been through our webinar, but it won't really help unless you have the space to practice. So the VIP room gives you the space to practice however you want. Let me just remove everything. So we have Fibonacci retracements, extensions, any horizontal raise that you guys want. So for example, if I see that this is a resistance and I'm not sure if my analysis is correct, you can go ahead and type a message in the chat box. So like maybe Desmond, hey, you can see that there are a lot of people in this chat. So if you put it in, there are many people who will be willing to help you, as well as some of our pro analysts as well. I am also in this chat, so you can go ahead and type it in. I don't know why it's not showing up. Okay, but you can tag whoever you want. Hey Desmond, is this resistance valid? And then you can highlight the resistance, link object to text, and then click on this. And then you can just send it in. So we try to reply as soon as possible. I think within 24 hours, you should get an answer. Yeah, so if it works for Fibonacci as well, if you want to check your retracement, like is this valid, you can go ahead and tag that as well. Link object to text, and then you can choose which level you want. So maybe like 50%, and then it'll choose it for you. So confirm, and then when I go over it, it will highlight it. So whoever is reading your chat will know what exactly you are referring to, and they'll be able to help you better. Same for the Fibonacci as well. 50%, so you can see the 50% is being highlighted. Okay. Okay. If there are any other questions, you guys can drop them in the chat. But if not, yep. Thank you guys so much for coming today. Let me just open the chat. Okay. Yeah, thank you guys so much for coming today. Have a great rest of your week. And I'll see you guys next week. Yeah, I think there is a way to see the recording. I don't think you can download the presentation slides, but the recording for this webinar, yeah, it's being recorded. Let me just see where you can find it. I think you can check the IronFX page, the website. Okay. Any other questions? No? Okay, thank you guys so much. I'll see you guys next week. Yeah, this may be a little bit difficult to understand, but no worries, you can go back and watch my presentation again. Um, and practice it on your own in the VIP trading rooms, and we'll definitely help you out over there. I think it would help you understand better if you actually played around with the Fibonacci retracement levels. Yeah, thank you guys. Bye.